You know, when I first started trading, boys, I used to hold trades for quite a long time, right? I used to think that swing trading, or even if you're not swing trading, but just getting into a position and holding that for 10, 20, 30 plus points was the most effective and profitable way to trade. And that's sort of a thing that a lot of new traders get into their mind is that, holding longer term trades, doing higher time frame trades is somewhat more profitable. And that, that scalping or anything on the lower time frames is just noise or gambling or flipping a coin, right? That's the general consensus among newer traders. And I was victim to that as well. But as my trading has progressed, this is my 6th year of trading now, 2nd year trading futures, but 6th year of trading. I have, come to the realization, along with the help of professional traders, actual professional traders, I've come to the realization that actually scalping and short-term trading is the best bet we have at profitability as retail traders. Now, let's elaborate on that a little bit further. If you are reading a book, right, say you've got a massive book about that thick, maybe a Harry Potter book or whatever the heck you're into, you got a book about that thick, you're mid-sentence, right, you're reading, you're in chapter 2, which one is easier to predict, right, based on the context you have. Is the current sentence easier to predict the end of what it's going to say at the end of the sentence based on what you've already read? Or is it easier to predict what the end of the page, the end of the chapter, the end of the book's going to say? The wider the time horizon on your trade, the harder it becomes to predict where it's going to end up. If we put that into trading, for example, say you go and get long at an area of support. You get in long, you get a quick bounce from the area of support, you take 10 ticks, you close the trade, you've secured 10 ticks. Nice and easy. You can say based on where we're trading, based on the order flow, based on where we are in price at the time, are we likely to get a bounce from here? Yes, cool. Let's get long. You get that bounce, you take your 10 ticks, you've secured a profitable trade for the day, and you can leave it at that. Oh, fucking bubbles. Well, let's say you get in long at that area of support and price goes up 10 ticks. The trade is profitable so far. You entered where there is a higher chance of price getting a bounce. You enter in long from the area of support. It goes up 10 ticks, 12 ticks, 13 ticks, 14 ticks. And you're like, I'm going to hold this until I get 60 ticks out of this move. Because you're trying to trade this massive 1 to 3R, or you're trying to trade on a bigger time horizon than just a small scalp or 10 tick trade. So you're trying to hold this trade longer and longer. The longer you hold this trade, the more of a victim you become to the randomness of the market. That trade could go up 12, 13, 14 ticks. Suddenly the book flips and that trade's now coming all the way back down to your entry. Now what do? Are you going to chicken out, close the trade with a couple of ticks profit? Is your stop already at break even? Or is your stop still at the same place, but now price is coming back down for a deeper retracement into that support zone, takes out your stop, whipsaws back the other way, and now you've just taken a loss, and you were green at first, but you chose to keep holding because something inside said that you knew where price was going to go. Somehow you think you know that you are good at predicting where price will be in the next 5, 10, 15, 20, 30, 40 minutes. Somehow you're like, oh, the algorithm has to rebalance the other side of the range. It has to do it, so it's going to reach that other end. Well, you don't know shit. What special information do you have that informs you where price is going to be, where price is going to rebalance to? You have no idea. And even if you did have some sort of idea, you were some sort of enigma master trader, there is an element of randomness to the market as well. You could get long at that point of support. And like in the example just previously mentioned, price goes up 10 ticks, whipsaws back down for a deeper retracement, which goes down against you 40 ticks and then comes back up afterwards. You just don't know. You could have the right direction, but your entry could be a little bit off. So the longer you hold a trade, the more of these variables you open yourself up to. Whereas if you're scalping from an area of statistical probability that you're going to get some sort of bounce, some sort of reaction, you're scalping from that entry point, your trade is in and out normally, in less than a minute. So you're not exposing yourself to the randomness of the market as much as if you were to hold a trade for a longer period of time. And then people say, oh, but you can't really make that big of a trade when scalping. But you can, all right? Scalping doesn't mean you have to be in and out of the market all day, all session. You could literally just take that 1 10 tick trade and that could be your trade for the day. The good thing about trading is we can scale up fairly large before it becomes a problem. So you could say 10 ticks on gold. Say you're a guy who looks for $1,000 a day on your Top Step account or whatever. 10 ticks on gold, which is what I'm trading at the moment. 10 contracts on that one move, 1-to-1 risk to reward ratio, and then within 10 ticks you've made your $1,000. Under a minute for it to take that 10 tick bounce, and then you can call it a day there, and you haven't had to expose yourself to the markets for a long period of time, and you haven't had to sit there in front of the screen bloody shaking in your boots hoping that the trade's going to continue towards your take profit. And with these scalping trades, it's the way I trade. Normally I'm aiming for about 10 ticks per setup when I'm trading these days. But you can also have these trades if you do want to leave it on to secure more. If price does end up moving more and more in your favor, that's where you can obviously split your position up. So I like to take the majority of my position off at plus 10 ticks, or based on the order flow at the time, and then leave 1 to 2 contracts on just to run to see if I can squeeze much more. And I'll trail my stop loss up, leave that stop loss then at my plus 10 ticks, and if the price keeps running on up, I can secure more out of that move and follow it up with a stop as well, with a manually trailing stop to secure more. So you have options like that, but because I've already secured the majority of the profit on that first 10 tick movement, it's basically stress-free at that point, and the money's been locked in. And if I am so lucky to get a good, decent runner out of it, I can secure profits from that as well. Because scalping tends to get a bad rap from retail traders and newer traders more specifically. But after spending a lot of the last year learning from and talking to legit professional traders in the industry, the general consensus is that scalping is one of the least risky ways to trade. And when you've got a good read on the market and a good system in place, it's one of the better ways to be a more consistent trader. So anyway, just a little rant on scalping. If you guys want to watch me trading live, I scalp using order flow and volume profile levels every day, live here on YouTube Monday to Friday for the London Open trading gold. So you can check that out live there. Otherwise, I'll see you in the next one.